Another day, another bloodbath. All of the major gauges were red today, and the uncertainty of Trump's policies are bringing out the bears. But could today have marked the bottom? The bears couldn't break the put support level, global liquidity is increasing, and Broadcom is up 8% in after hours on flawless earnings. If semiconductors begin to make a move, technology stocks will make a move, and if tech goes higher, so goes the market. So should we continue to wait for a better entry point, or is now the time to load the boat? That's what we're going to talk about today, along with seasonality, sentiment, and why this chart should have everyone concerned. So should we buy the dip, or is this the end? We've got a lot to talk about, but before we roll the tape, if you want my newest global M2 liquidity leading indicator, which predicts the path of the Nasdaq 100 as well as Bitcoin flawlessly, follow me on my second channel and I will provide it completely for free in today's video. So let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks tanked to session lows on Thursday after more tariff whiplash came from the Trump administration. And guys, like most of this week, we saw selling in most S&P 500 sectors and then buying in the defensive sectors. Look at healthcare, right? The defensive component of healthcare, the insurers, the health services, they were green. Consumer staples here were also very green, or consumer non-durables. And then communication services were also in the green. Just the defensive sectors sprinkled in with a couple of other stuff. Comcast was up 2% here today. Same with John Deere. We had a couple of other healthcare names in the green, but all in all, a very red day across the board, except in energy. And guys, technology taking it on the chin, particularly semiconductors, and semiconductors really feeling the whiplash from all of just the uncertainty and the policy making. Once the chip industry gets clarity on policy, export controls, etc., we're going to see these stocks rally. But AVGO reports earnings today. We're going to talk about them a little later on in the video. But nonetheless, Nvidia down 5%, AVGO down 6%, and all of hardware just really taking it on the chin today. Software was no different. Meta down 4%, Oracle, Netflix, CRM, IBM, Palantir, ADP, they were all down in a very big way. Same with Microsoft and Google, Amazon, Costco was down, Home Depot was down, Walmart was down. It was just an ugly day across the board. And the S&P 500 had its worst day of 2025 today, down 1.8%. Selling was led by the technology sector, real estate, and the discretionary sector. And it was clearly a liquidation today. Gold down 0.52%. Staples was up only 0.19%, still green. And then we saw the energy sector do its own thing. Nonetheless, we just saw lower lows, lower highs, and just complete outflows here in the market. And again, it was really just led by growth stocks, particularly large cap growth and large cap core. They really took it on the chin, but don't discount the fact that mid-cap growth saw selling, and same with small-cap growth. They saw selling too. Small-cap value and small-cap core outperformed their relative counterparts, and the best performing sector here today was actually large-cap value, only down 0.41%. Nonetheless, still a red day, selling in all of these sectors, and if you were indexed to the market, you really saw red in your portfolio. And the reason for that was simply just tariff uncertainty. When Trump puts tariffs on, backs tariffs off, the market doesn't really like that in light of positive news. We actually did get positive news from the Trump administration. Trump delays tariffs on many products from Mexico and Canada. He paused tariffs on products covered by the USMCA, that's the United States, Mexico, Canada Free Trade Agreement. However, he did later stay many tariffs on many Canadian imports. So a little bit of good news here. This is a read-through telling us that there is negotiations happening behind closed doors, but obviously the market simply doesn't like the uncertainty. We actually got pretty good economic data today. Imports and exports as well as the balance of trade came in as expected. This is the big reason why we saw a massive fall in GDP. Imports actually subtract from GDP, guys. Remember that. And we've seen a lot of companies importing a lot, front-running tariffs in aggregate. Initial jobless claims actually beat expectations, 221 versus 235. This is very, very good. However, based on the ADP numbers, I think we are going to see a weaker than expected non-farms print tomorrow. And I think that is consensus. So if we do get a huge upside surprise in non-farms, I think the market's really going to rally on that. But I'm expecting the worst, hoping for the best. And I think we're probably going to get less than 100,000 in non-farms. The expectation is for close to, I believe, 140,000, somewhere along those lines. There was a couple of bright spots, especially early on in the market. JD reported their earnings and they were up as much as 6%. All of China rallied. They were very, very green in the pre-market. However, just the negativity that we saw in the market today led these stocks to finish pretty much slightly down to flat line. Now, there were a couple of big earnings names reporting today. Broadcom up 8% here in the after hours, but down 6% today on the back of what was just incredible earnings. You know, they really supporting the semiconductor space right now. Now, they actually beat sales. They beat EPS, grew by a very, very big component. Growth was driven by their AI segment. EBITDA beat expectations by a lot. EBITDA came in at $10.7 billion. The expectation was for $9.7 billion. That is a huge beat in EBITDA, owing to the fact that they're really honing down on cost controls while growing. You love to see that operating leverage build into the stock. If you guys want me to cover Broadcom in the second channel, FinFluential Media, go ahead and leave a comment and we'll look at Broadcom as well. But the big thing about Broadcom's earnings was actually their guidance. The street was expecting $14.7 billion in revenue for Q2. Broadcom came out and said, we're going to do $14.9 billion and actually have an EBITDA margin of 66%. The street was expecting 65%. So it was a double beat, a raise with margin expansion. That is why the stock is up 8%, and do expect this to go higher in normal hours trading tomorrow. Costco is a stock I might cover on the second channel as well if you guys want that. They were down 1%. Again, they reported their earnings. Now, they actually beat revenue expectations, but missed earnings per share expectations. And that really goes to show that, hey, people are coming in to buy their products, but they aren't able to pass on those costs effectively onto consumers, and missing expectations, meaning margins are contracting. That is why we saw the stock down 1% here, the after hours down 2% today, and well off the highs on the day. Not great earnings here from Costco, but I didn't dive into them significantly. We'll cover both these names in the second channel, FinFluential Media. I'm going to leave a comment in the description. But today was another day of very poor breadth. 2,000 advances, 4,100 decliners, and we saw very clear outflows from midday. Outflows in the Nasdaq 100, outflows in the New York Stock Exchange, and the S&P 500 finishing just shy of 2% down on the day. Market momentum also looking a bit sick. Look at the 200 and 150-day moving average. Stocks are not acting well at all. A lot of stocks are losing their 200-day moving average. And if you really want to see the market make a move, you want to see an uptick in shorter-term averages and an uptick in medium-term averages. We're simply not seeing that. In fact, compared to last week, we're actually seeing a movement down. So more stocks continue to sell. And that has really been the theme of this week. It's really been a week for the bears. But let's hop on the chart. The S&P 500 down 1.78%. The Nasdaq 100 down 2.79%. The IWM down 1.53%, outperforming the larger cap stocks. The RSP down 1.1%, and mid caps and small caps in between, or profitable small caps, I should say. We are seeing a little bit of bullish price momentum in the after hours, and that is because of Broadcom's earnings. They're up 8.3% here at ticker AVGO. Nvidia up 1% as well. Costco down 1% as a result. So AVGO lifting semis and tech as a whole. We'll see if that continues tomorrow, but in the here and now, things looking slightly positive in the after hour. And this could be the catalyst that really turns everything. However, very weird price action. Volatility spiked up in a big way. The 2-year yield fell and the 10-year yield actually gained. So what the market is telling you here is that because we saw the 2-year yield fall, the market is really concerned about what the economic picture in the short term. But in the longer term, the market is saying, hey, everything's looking A-okay. In fact, yields rose, and I think that was on the back of the better than expected initial jobless claims. The DXY was actually flat. The dollar here at the 104 area. I think we're going to see a consolidation and a digestion of the big move we've seen in the last couple of days, but I do expect it to go lower. Maybe we might see a 100 DXY in the next couple of days. The AGG and TLT fell as a result, and that's because the 10-year and 30-year yield gained ever so slightly today. Bitcoin was up 1.45%. Gold fell, silver fell, commodities not acting very, very well. And then you can see here in the after hours, Nvidia, AVGO looking very, very good. Now guys, let's actually talk about Bitcoin. I want all of you to go ahead and follow me on my second channel, FinFluential Media. And on that channel, I'm going to talk about Bitcoin quite a lot. And I'm also going to provide you guys with this indicator right here. This is a global money supply indicator that I have created. You can see it tracks Bitcoin very, very well. However, it's lagged by about 3 months. And this pretty much tells us what Bitcoin is going to do next. So I'm looking for Bitcoin to make its next move higher in late March, potentially as early as April. And then we should see this go through. The reason why we have seen a pretty big uptick in the M2 in money supply, a lot of global central banks are cutting rates as well as looking at stimulus from China to Europe. And we have seen an uptick in the global money supply as a whole. This does trickle down into Bitcoin and assets as a whole. And so if you guys want this indicator, go ahead, follow me on my second channel. When I release the Bitcoin video, I'll also be releasing this indicator right here. You can actually change the offset of days and you can actually make it apply to the S&P 500. There's a little bit of an offset, a little bit less of an offset with the S&P 500. It works very well with the Nasdaq 100. You just have to adjust the offset. I will give you the entire indicator for free. So go ahead and follow me on my second channel, guys. But this indicator works exceptionally well for Bitcoin as a whole. But let's actually go ahead and talk about the S&P 500 and what we actually saw today. So another red day in the S&P 500, but look, what's been new? We are clearly still in a daily downtrend and a very red candle down 1.8% in the S&P 500 today. We actually did break the put support, but what we really saw was some bullish momentum from the lows. We did see buying at both the bottom and the top of this candle. The bears definitely won, but it does look like we are starting to form a bottom here. We saw quite a lot of buying at these lows in the last couple of days, and we did at these lows as well. However, if we continue to move lower, the put support will move lower as well. And we are forming an equal low right before we had this Trump gap up right here. So this is a very, very critical spot. If we go ahead and break below this level right here, we probably go to the 5,500 area. So bulls need to make a stand at this 5,700 level, or we probably are going to move another 200 points to the downside. We are in negative gamma, so we do see erratic movements in price, and that was exemplified by today's trade. We actually saw some very positive momentum here to start the day off, and then we just saw lower lows, lower highs. However, we did actually put in a bottom here, a pretty wide bottom, but you do expect that in negative gamma, and this consolidation happened right here at the put support. That's kind of positive for a low to be put in. But ideally, what you really want to see is not just a low put in, but like a movement to the upside. But we'll see if we get that tomorrow, especially because we are looking very green here in the after hours. Again, on the back of Broadcom's earnings. But we are, however, guys, we are still in a daily downtrend, and we are starting to make lower lows and equal lows relative to some of the key lows we made here previously. And that is obviously not a good sign. I think if we get a close below the put support, that definitely opens up some very, very key and low levels into late March. I am expecting a bottom to occur around about the March OPEX. So we're looking anywhere from about the 18th to 26th. I know that's a wide date range, but that's all I can provide right now. But we are looking for a bottom. But do expect that if we do close below here, guys, expect a massive capitulation to like the 5,500 area. However, if we do consolidate right here, that can be very constructive for us to move higher, to retake the gamma flip, and then to go retake the put support. Nonetheless, we are in a downtrend, and I wouldn't really putting everything in the bag right now. I would be dollar cost averaging into the S&P 500. This is a dip you want to buy. We will go higher, guys. I do think we definitely are going to go higher into most of this year. This is just some typical volatility that we do see in equities. And again, we measure it peak to trough, we're down 7%. Nothing crazy. It's not even an official correction just yet, but it is still a scary price action, especially considering what we've seen in the last year of just higher highs, higher lows. Where we have seen an official correction is in the Nasdaq 100. Peak to trough, that we've actually seen a pullback of about 10%. And we can actually see a little bit more downside here in the Nasdaq 100 because we're not quite at the lows of the put support at the 19,800 level. So we can actually see a little bit of more selling However, do expect us to find a bottom here, especially as that March OPEX comes around. Again, that's going to be on the third Friday in March. So that is exactly 2 weeks from now. What am I expecting for the Nasdaq 100? I am expecting us to continue to move slightly lower. We'll find a bottom right here. And then what we want to look for is areas of support. If we can find support, we can then predictably say we are going to move higher, but that will be dependent on if we find support right here. The move can definitely go lower. We did make a lower low relative to this low and this low right here. So this is the next key level of support. But the Nasdaq 100 has a ton of areas of support, unlike the S&P 500, which is just a void up until the 5,500 area. The Nasdaq 100 has some very, very key areas where we can find support on the way down. And the very first level is this 19,830 level, or the put support level. I'm constructive on all of equities right now. Yes, we are officially in a correction in the Nasdaq 100 peak to drop, but nothing to really be concerned about. A 10% pullback, we get about one of these every single year. We actually did get one last year. In fact, we got a pretty big correction peak to trough in the Nasdaq 100 in 2024. It was about a 15% move. And if we see something very similar, don't be surprised. If we are to measure where a 15% move will take us, right, it would take us right to about here, sort of the 18,800 level. So that is not out of the realm of possibility. There still is 2 weeks until that March OPEX. I'm expecting a bottom around, the 18th to 26th. Maybe somewhere in the middle, the 21st to 22nd, somewhere around there, we'll put in a bottom and then we can make the next move higher. But do expect much more volatility to come. Looking at the RTY, very similar situation. We're finding support here at put support, and I'm a strong buyer. The RTY is about 3% away from being in stock market crash territory. That would be a 20% move or lower. That would be considered a bear market. Pretty ugly trading if you look at the IWM nonetheless. I do like the IWM, but I much prefer the S&P 600 over the Russell 2000 in my opinion, guys. Now, I wouldn't say things look ugly for equities. This pullback we're seeing, this sell-off we're seeing looks very, very orderly. We have some red days sprinkled in with some green days, some short covering. It's not like massive, massive candles like we saw in a complete liquidation event. It is very orderly, and there is reason behind the madness, and this is why I'm confident we are going to go higher. However, do expect us to definitely continue to go lower and or find consolidation at this area right here. We could definitely see a green day tomorrow, especially after Broadcom's earnings. We have to see how the market assesses that in normal hours trade. But, I'm pretty constructive, and I think you actually want to start adding and dollar cost averaging into this area right here. We can definitely go lower, but volatility is the price you pay for outsized returns in equities. And what could definitely support stocks is the continued momentum in the 10-year yield. Now, we did see a little bit of a move up from the 4.1% mark. That's exactly what we said. Why? Because it was a low we put in here. But the bears did come in, and we should potentially see this next move lower, making a lower low. And our next target would be the 4% mark in the 10-year yield. Now, the dollar is consolidating. We're approaching the 103 area. I said we broke the 105. This will be the next area where we find support. And we're kind of seeing that right now, front running that support level just a tad. But I do think we're just going to consolidate all of the move we saw here in the dollar. This entire move, I would say, we're just going to consolidate. And then we'll choose to go up or down based on Trump tariffs and Trump as a whole. But looking at dollar seasonality, we should continue to see this move lower. And I think we should see 100 DXY by the end of the year. That's going to be a huge tailwind for S&P 500 earnings in Q1, Q2, and Q3 for this year, and pretty much for the whole of 2025. And as long as the dollar falls and the 10-year yield continue to fall and earnings remain robust, I am a buyer of stuff like the S&P 500, the Nasdaq 100, the S&P 600, and even mid-caps. Mid-caps looking pretty all right. The RSP, not looking bad at all. In fact, if we find support at this level, that would be a great opportunity for you to buy and go higher. Let's actually measure where we are in the RSP peak trough right now. We're at a 7% drawdown from where we closed last. But if we actually go ahead and measure the peak to trough drawdown, 8%. So not quite a correction, but we're definitely approaching collection territory. Looking constructive, and I would be a buyer here at the 173 level. I think we're going to go ahead and break 200 area in the RSP sometime in 2025. $1.25. You had it there, guys. Dollar cost average, start buying the dip. Do you think we are going to go higher? There is still 2 more weeks of a bloodbath coming, but start deploying capital right here. We will go higher into the end of the year.
And guys, let's talk about sentiment. We saw another day with fear. Now guys, let's talk about sentiment. We saw another day with sentiment here in extreme fear. And until we actually get a sustained rally, a sustained period of consolidation, and for us to move into positive gamma, I think we are going to remain in this extreme fear, even in this fear territory. There's a lot of uncertainties and unknowns with policy and this administration. The market hates uncertainty, so do expect more of the same. However, this is the zone where you want to start accumulating, especially in names such as Nvidia, which is down 20% from its highs. I think the semiconductor complex looks very, very healthy. And there's quite a number of stocks that are well off their lows that are starting to see a bit of life in them. Now, at the end of the day, guys, you do have to understand that volatility is the price you pay for outsized returns in the stock market. Okay, you do have to understand that corrections and dips, this type of stuff we're seeing now, is completely normal. In fact, we normally get about 10% pullback every single year, and we get a 15% pullback at least once every second year. But when you look at something like 3% or a 5% dip in the market, right, or a mild correction, we get these as much as 7 or 3 times in the market. So guys, the volatility we're seeing is historically normal, especially when you look at seasonality, right? Sort of from the middle of February into the middle of March, right? What we normally see is sort of sideways to downward momentum. It's only after around the 13th of March, right here, the middle component of March, where we tend to see a little bit of a bottom and then an extreme rally to the upside. And then we actually see consolidation for the remainder of March. So it looks like within 2 to 3 days here in March is where the majority of the gains are made. Net, we should expect to see anywhere from a 1-2% gain in March. Again, this is historically and seasonally speaking, but I don't know if that is going to be the case this year because there's a lot of macro uncertainty. Look at the GDP forecast. Now, this is BOFA's Q1 GDP tracker. It's down from 2.3% to 1.7%. Again, largely due to higher than expected January imports. Imports subtract from GDP, exports increase GDP. Businesses are front running tariffs, and that is why we're seeing this huge pullback in GDP. Now, Fed's GDP now, see GDP at 2. Now, the Fed's GDP now is well in the negatives. BOFA don't really see that. They see a negative. They just see a 1.7% print. And again, this is probably once you adjust for those imported inventories. Betting markets see a recession or a 42% chance of a recession this year. This has been a steep increase. This is a 1-year chart. You see that ever since Trump came into office, we actually have seen recession risk increase while it's still below the 50% mark. However, one thing you do have to take into consideration is that betting markets tend to be right. They call the election and, betting markets do a really good job at just being genuinely right all the time. However, this can change in a dime. Now, what could bring on that recession? And I think part of it is actually the jobs market. We got the ADP numbers. So the economists were estimating about 140,000 in ADP. This was yesterday's numbers. We actually missed those. We actually printed 77,000 in private payroll. So we missed by a very, very wide margin. This doesn't read through well for the NFP. And we're going to talk about our expectations for NFP a little later on in the video. And for everything we're seeing with the macro, what we are seeing is that year ahead inflation expectations have risen. As you can see in 2025, these are the expectations. However, the longer term expectations have remained pretty anchored. So we might see an inflation scare, but it shouldn't materially impact the inflation outlook looking 3 and 5 years ahead for both services and manufacturing. Now, looking at earnings tomorrow, guys, Friday, there isn't really anything that's worth noting. The majority of the big names are behind us, but we do have some pretty high impact data. The biggest being the non-farm payrolls and the unemployment rate. Now, the market forecast consensus here is for 4%. Now, something with the government layoffs that we have seen from the Trump administration, they're getting pretty long and drawn out severance packages. So those figures are probably not going to materially impact any of the employment reports or the initial jobless claims reports up until September. around about then. It really depends what those packages looks like. That is my best guess. But for now, we are seeing the unemployment rate stay stable at 4%. If we hit 4.1%, that could be a bit of a doozy. You could see that the consensus here is for 4%. And this is on the back of non-farm payrolls coming in at 160,000. And just for the record, Bloomberg's estimates are actually looking for a 65,000 non-farm print. So this is sort of like probably Wall Street's expectations. This is trading economics consensus. That is what we previously saw the unemployment rate to come in at 4%. It really depends what's going to happen. There's just a wide range of outcomes that could happen. So I think if you're a trader in this environment or an investor, expect the worst, hope for the best. We also get average hourly earnings year over year, month over month. These numbers are expected to come in at 4.1% for the year, and then a 0.3% consensus for the month. The participation rate will probably be around about 62%, and then we get a ton of Fed speakers, but the most important is actually Jerome Powell. He has a speech here tomorrow. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.